The secret empire of derivatives in India. How an American firm discovered the world's most lucrative money-making machine. Imagine a market where for every dollar invested in stocks, more than $400 are being bet on futures contracts. Sounds insane? Welcome to India's financial market, the wildest casino on the planet. While 9 out of 10 Indian traders lose half of their annual salary in these bets, an American company found a loophole that generated billions. A strategy so efficient it outperformed giants like Morgan Stanley. So controversial, it ended up being banned by the Indian government. This is the story of how Jane Street turned India's financial chaos into its own money printing machine. To understand the magnitude of this phenomenon, we need to go back to the early 2020s, when India was experiencing an unprecedented economic boom. The country was going through a digital gold rush, with millions of young Indians discovering the financial markets for the first time. Trading apps multiplied like mushrooms after rain, promising easy and quick wealth. The democratization of access to financial markets, which should have been an achievement, ended up becoming a trap for millions of people. India created a financial monster. Its derivatives market is not just big, it is absolutely disproportionate. To put things into perspective, in the United States, the derivatives market is 9 times larger than the stock market. In India, 422 times larger. The numbers are frightening. Daily trading volume of $4 trillion in derivatives, 80% of all global options bets happen in India, and in 2023, 51 billion contracts were traded, nearly doubling the global volume. This exponential growth happened in less than 5 years, turning India into the world's epicenter of financial speculation. What makes this situation even more concerning is the profile of participants. We are not talking about sophisticated institutional investors or hedge funds with decades of experience. Most are young men between 20 and 30 years old, many of them using personal savings or even borrowed money to bet in the markets. They are drawn by the promise of quick gains, influenced by YouTubers and influencers selling courses on how to get rich trading, creating a bubble of unrealistic expectations. But there is a darker side to this explosion. Studies show that 90% of retail traders lose money consistently. The average loss, 110,000 rupees annually, half the salary of a typical Indian worker. It's like someone earning $60,000 a year, losing $30,000 betting on the stock market. A massive financial bleeding that fuels this machine of reckless speculation. For many families, this represents not only financial losses, but also the end of dreams of higher education for their children, buying a home, or having security in retirement. The situation worsens when we consider that many of these novice traders use extreme leverage, multiplying both potential gains and losses. It is common to find people investing 10, 20, or even 50 times the amount they actually own, creating a devastating domino effect when trades go wrong. In addition, the addictive nature of trading, with its constant adrenaline and the illusion of control over outcomes, creates behavioral dependencies similar to compulsive gambling. Founded in 1999, Jane Street remained in the shadows for decades, a proprietary trading firm, meaning they bet with their own money, not clients. This gives them total freedom for aggressive and controversial strategies. For a company few had heard of, its numbers are astronomical. $20.5 billion in trading revenue in 2024, profit margin of 64%, and an estimated $4.6 billion profit in just the first quarter. The company operates like a war machine, employing some of the world's best mathematicians, physicists, and engineers to develop algorithms capable of identifying market inefficiencies in milliseconds. What differentiates Jane Street from other trading firms is its obsession with speed and precision. They invest hundreds of millions in technological infrastructure, including private fiber optic cables, co-located servers in stock exchanges, and microwave communication systems. This technological advantage allows them to execute thousands of trades per second, capitalizing on price differences that exist for mere fractions of a second. It's like having a financial time machine, always one step ahead of other market participants. Jane Street entered India in 2020, initially discreetly, studying the peculiarities of the local market. 3 years later, in 2023, their profits skyrocketed. Coincidence? Definitely not. India had become their personal goldmine, and Indian regulators did impressive detective work, mapping exactly how the company operated. The strategy had a technical name: intraday index manipulation. In practice, it was brilliantly simple and extremely profitable. Jane Street's research period in India was meticulous. For 3 years, they analyzed behavioral patterns, identified times of peak volatility, studied correlations between different indices, and most importantly, discovered how the options market reacted to movements in the stock market. They realized that the Indian market had a unique characteristic. It was possible to significantly move stock prices with relatively small investments, and this caused disproportionate reactions in the derivatives market. The most valuable discovery was understanding that the Indian market operated with asymmetric liquidity. While the options market had abundant liquidity, you could buy millions of dollars worth of contracts without significantly affecting prices. The underlying stock market was more sensitive to large trades. This asymmetry created the perfect opportunity for the cross-market manipulation that Jane Street would later develop. Let's dissect a real trade on January 17, 2024. The Nifty Banking Index opened down 3% due to poor results from HDFC Bank. In the first phase, Jane Street aggressively bought bank stocks, representing 20 to 25% of all purchases and investing around $500 million to artificially stabilize the index. This operation was not random. They knew exactly which stocks to buy, in what quantity, and at what times to maximize the index's impact. Timing was crucial. Purchases were concentrated in the first 30 minutes of trading, when volatility is naturally higher and fewer traders are active. Jane Street used sophisticated algorithms to distribute the purchases in ways that maximized psychological impact on the market. They not only bought the stocks, but did so visibly, creating the impression that large institutional investors were confident in the banking sector despite the negative news. While holding up the stocks, the firm executed the second phase, buying put options, bets on a decline. Since the index was stable due to their own intervention, these options became cheap. They invested 7 times more in options than in stocks, setting the stage for the final blow. The diabolical beauty of the strategy was in its simplicity. They were artificially lowering the price of bets they knew would pay off within hours. During this phase, Jane Street used multiple accounts and different brokers to mask the real extent of their options positions. They bought contracts with different strikes and maturities, creating a complex web of bets that, individually, looked like normal hedging operations, but collectively formed a massive bet on the index's decline. Coordinating these operations required an impressive level of technological and operational sophistication. In the third phase, Jane Street sold all the bank stocks at once, pulling the rug out from under the market. The index naturally plunged, and the put options skyrocketed in value. The result? A few million in stock losses, $85 million profit in options, generating net profit in a single day of about $85 million. But that was just one day. They repeated variations of this strategy hundreds of times over 2 years. The impact of this operation was felt by thousands of small investors who were on the opposite side of the bets. When the index plunged that afternoon, many retail traders who had bought call options, bets on a rise, lost their savings. Some had used their last financial reserves, betting that the market would recover after the morning drop. Jane Street's manipulation not only generated astronomical profits for them, but also amplified the losses of retail investors. The supreme irony is that Jane Street gave themselves away. In April 2024, they sued two former employees for allegedly stealing the Indian strategy. In the lawsuit, they inadvertently revealed they had made $1 billion in profits in 2023 in India alone. Bloomberg published the story. Indian regulators read it, and the investigation that would bring down the scheme began. The arrogance of suing ex-employees over a strategy they themselves knew was questionable shows how confident they were in their impunity. The lawsuit revealed fascinating details about Jane Street's internal operations. Internal documents showed the company had a code name for the Indian strategy, Project Mumbai. Emails between executives revealed discussions about regulatory risks, but also confidence that the enormous profits justified any potential risk. One executive even wrote, "It's like finding money on the ground every day." SEBI, India's regulator, was crystal clear. It's not illegal to operate in multiple markets simultaneously. The problem was the intensity, scale, and intent behind the operations. As they explained, buying stocks in the morning and selling them in the afternoon at a loss is not a normal profit strategy unless you're manipulating something else. The verdict was devastating. Estimated illegal total profit of $4.3 billion. Between 2023-2025, a $570 million fine and a temporary ban, later lifted. SEBI's investigation lasted 8 months and involved forensic analysis of millions of transactions. They reconstructed Jane Street's operations day by day, identifying patterns that only made sense when seen as part of a coordinated manipulation strategy. The final 100-page report became a case study on how to identify and combat sophisticated market manipulation in the digital age. The Jane Street case exposes a systemic vulnerability. When derivatives markets become disproportionately larger than the underlying markets, they create opportunities for manipulation. While Jane Street made billions, millions of small Indian investors lost their savings. A transfer of wealth on an industrial scale from the weakest to the most sophisticated. This situation raises fundamental questions about the fairness and efficiency of modern financial markets. The social impact of this wealth transfer goes far beyond numbers. Entire families saw their future plans destroyed. Young professionals accumulated debts that will take years to pay off, and trust in the Indian financial system was severely shaken. Meanwhile, Jane Street used its profits to further expand global operations, hire more talent, and develop even more sophisticated technologies. This case will force regulators worldwide to rethink limits on the relative size of derivatives markets, monitoring of cross-market strategies, and protection for retail investors. Jane Street's story in India is more than just a case of market manipulation. It is a warning about the risks of financial markets growing faster than their supervision. We are already seeing movements in this direction in several countries, with financial authorities implementing new rules to prevent this type of manipulation. A costly lesson. In deregulated markets, money always flows from the less informed to the smarter. And when billions are at stake, even Wall Street giants may cross the line between intelligence and illegality. The next time you hear about a can't-miss opportunity in the financial market, remember, if it sounds too good to be true, someone has probably already found an even better way to profit from it. What do you think about global market regulation? Leave your opinion in the comments and subscribe for more analysis on the behind the scenes of the global financial market.